All right, segment 2, purchase loans and first-time home buyers. This part gets me real excited because, first-time home buyers, it's so exciting to think, wow, you're there. You're finally going to be able to go out and buy your first home. And it's so exciting. I just remember going into a home and just falling in love with a home, or just knowing it was the right one. And usually a lot of times it wasn't, but it's so exciting to think about actually buying your first home and making a home for your family. Next. So we've got lots of different purchase loans here. So let's go ahead and tell you what I based this on. So I based it on a 620 middle credit score, and I based it on a loan of up to $822,375. So that sounds like a pretty random number, and where that number came from is Fannie Mae and Freddie Mac are quasi-government agencies that they help regulate mortgages and making sure that they remain affordable, because it's such a big part of our economy. And they came up with a high balance conforming loan, and that limit for FHA, VA, and conventional is $822,375. So that's where all these programs is the height of all of them. So let's go ahead and start out with government loans. Government loans, there's two types. There's VA loans under the Veterans Administration, and then we have FHA under the Federal Housing Administration. Then we have conventional. We have the Home Ready Home Possible at 3% down. We have a 5% down. We have the Cal State Federal Credit Union, the Cal State LA Federal Credit Union 80-10-10, which is an awesome product. And then we have 20% down. So let's go ahead and break these down a little bit more. So next. So we have VA loans. Now, VA loans, we have upsides, we have downsides to pretty much every one of these loans. And we're even going to compare these loans to show you. Now, something I wanted to mention is, I'm going to be going through some of these slides pretty fast. And I just want to let you know that tomorrow, I believe after 12, Dwayne is going to have this presentation emailed out so that you can have the numbers, so you can take a look at which program that you think would fit best for you, and you can have the numbers right there. Because if you're trying to write down all of this stuff that fast, I don't want you to be frustrated because I'm going too fast. All right, so the upsides are on VA loans as low as $0 down. That's amazing. It's the only program that's out there that I know of is $0 down on first-time purchases for veterans. And also, there's no monthly mortgage insurance. Usually, if you're going under 20% down, okay, most lending institutions are wanting you to either get a second or pay for mortgage insurance. And that's an extra cost that you're going to have to pay with your mortgage payment each month. And so, again, a lot of different varieties here. And a lot of what your decision is going to dictate is how much can you put down on your loan. The downside to a VA loan, there's a funding fee that can be financed into your purchase loan for 1.4 to 2.3%. If you put $0 down, you'll be required to pay a one-time 2.3% funding fee. So on a $500,000 loan times 2.3% is $11,500. Now, let me make sure that you understand that funding fees or upfront fees are not something that is by a lender or a credit union. It's something that the government charges for you to be able to do this loan. Let's go ahead and go to the next slide. Okay, so this is the breakdown. If we were to go ahead and go out and find a house for $500,000, this is how it breaks down. I wanted to get this in as much detail as I could for you so you can really take a look at this is what you're looking at. All right. So on the purchase price on this, it's $500,000. The loan amount is $500,000 plus the $11,500, so that you don't have to come up with that $11,500. They'll go ahead and put that into your loan right out of the gates. So our loan amount is actually $511,500. The rate is only 2.5%, which is, man, that is such a great rate at a 30-year fixed. Now we're going to go into another one of our acronyms, and that's PITI. That's principal and interest is 2021. Taxes and insurance are $575 for a total of PITI, principal, interest, taxes, and insurance for $2596. Now the $575 property tax, just so you can go ahead and figure that out on your own if you need to, is usually property taxes throughout the counties in Southern California, they vary a little bit. They go anywhere from 1% to 1.25%. Okay, so what we factored in this is we factored a 1.25%, and that comes out on a $500,000 loan to $500 a month. And then we factored $75 for homeowners insurance, which is required by any lender. You have to have homeowners insurance in case the house burns down, that the lender is protected and the borrower is protected. And I went ahead and put at the bottom to never forget that there are still closing costs associated with this, and they're about 1% of purchase price. Let's check out FHA loans. So an FHA loan, the upside, only 3.5% down payment, which again is so low. I mean, that is a very low down payment when you're looking at borrowing around $500,000. Okay, the downsides, 1.75% upfront fee. That can also be financed. Now it's a 1.75% upfront fee that can be financed into the loan just the same way as that VA can. And then they also have mortgage insurance on an FHA loan. Okay, so let me give you an example on the loan amount. So if you put the $17,500, which is the 3.5% down payment, that loan amount is $482,500 equals $347 per month for mortgage insurance. Next. So this is how this breaks down. All right, so on a $500,000 purchase, you're putting $17,500 down, okay? And then you have $8,443 is an upfront fee. So your actual loan amount is $490,943. The rate is even lower at 2.375% on a 30-year fix. Again, these rates are as low as I've ever seen. They're just great. Principal and interest, we got that acronym, and this one's a little bit different. Principal and interest is $20.69. The TI taxes and homeowners insurance is $575. Mortgage insurance is $347. Remember, on VA, you didn't have to pay mortgage insurance. And the total payment, PITI MI mortgage insurance, is $2,991, with, of course, the $5,000 for the 1% of the purchase price for closing costs. Okay. All righty. Well, let's go ahead and check out conventional. All right. So the first one in conventional lending, we have the Home Ready and Home Possible programs. Now, these programs, it's 3% down, but these are pretty tough to qualify in Southern California, just because the medium household income to qualify on it just makes it a little bit tough. But I wanted to throw it out there because in some cases it is still applicable. So the upside is only 3% down. Their mortgage insurance also is an upside, is it's only 0.55. So it's lower than FHA. So the example on a $485,000 loan, the mortgage insurance is $222 per month. The downside, Home Ready and Home Possible program your income must be 80% of the median household income for the county. It can be found on the Fannie Mae or Freddie Mac websites, but it's hard to qualify for because in Southern California, the houses just go for so much. And with the median household income, it's probably just over $60,000 for LA County. Makes it a little bit tough. You'd certainly have to be on the outskirts of the county to be able to use this program. But on the website, they have some exclusions. So on Fannie Mae or Freddie Mac, you can put in the address of what you're looking for, and it might be one of those exclusions for an area that they're trying to help people get into houses. Let's go ahead and see how it breaks down with the numbers. All right, so we got a purchase price of $500,000. At 3%, we're looking at a loan amount of $485,000. The rate is at 2.99%. So conventional is a little bit higher than the government loans on a 30-year fix, but still under 3%. I've been in mortgages for over 20 years, and I remember when it got down to 5.25%, and I told everybody it's never going to go any lower than this until it did. And I've seen it happen a couple of times. So it's just amazing. These rates they're historic. They're really, really great. Principal and interest, we've got $2,044. Taxes and insurance, so PITI. Taxes and insurance, again, are $575. Mortgage insurance, $222. So PITI-MI total payment of $2,841. Closing costs are $5,000 or 1% of purchase price. And know at the last page of this segment, I'm going to go ahead and put all of these next to each other. So you can go ahead and see which one would suit you best. And if you can save up more to get more of a down payment, it's very beneficial to do so. And you'll see it in the payments. All right, let's go to the next slide. All right, so we have conventional 5% down. Now with 5% down, that's one of the upsides, because 5% down still isn't a whole lot. On a 5% down, you're looking at $25,000 down, can be done, plus your $5,000 closing costs, you're looking at about $30,000 to be able to get into a home, which still is really reasonable. And you know what, we can use, we can borrow funds from a mom or dad or brother or something as well to be able to get this going. So you just sometimes have to get a little bit more creative to get that money. But, I think it's just such a great investment to get into a house. So low mortgage insurance, so only 0.42%. To come up with your mortgage insurance on this, the equation would be, is to times your mortgage amount by 0.42% and then divide that by 12, and you'll come up with your mortgage insurance. This is at $166 per month. The downside is it requires mortgage insurance because not all loans do. All right. Let's go ahead and see how the numbers break down on the next slide. All right, so we have a purchase price of $500,000, loan amount of $475,000, so that $25,000 down payment. The rate is at 2.99%. Again, a little bit higher than the government loans, but still under 3%, which is outstanding. Principal and interest are $2,002. Taxes, insurance $575 with mortgage insurance at $166. So the total payment is only $2,743. So we are getting into, the payments are starting to get less now, which gets a little bit more exciting and a little bit more affordable if we can come up with just a little bit more down. Again, closing costs are $5,000 or about 1% of purchase price. Let's go to the next. Okay, now here is a very exciting program, and this thing just broke out. This is not something that's been around for a long time. In an environment where values are going up, more and more programs become available. And Cal State LA FCU came up with this program, and I think it's just dynamite. And you'll see what the payment looks like when we get done. So the upside is 10% down. So 10% down is $50,000 down, but if you could, save up for a while, maybe use part of your 401k, to be able to get it, or your retirement, do you break out some of that, borrow from a parent. If you can, the upside is huge. So no upfront funding fees. So like the government loans, there's no upfront funding fee or no upfront fees at all. Also, there's no mortgage insurance. Another huge piece to this is that money. So upfront funding fees and mortgage insurance are just money you're kind of throwing out the door. It's nothing that you benefit from. It gets you into a really low down payment, but that money's just gone, and I hate to see that thrown into the wind. The downside is higher down payment, but economically it makes so much sense. So let's go ahead and break down the numbers on this, and you'll see. Next. Okay, so we have a purchase price of $500,000. I'm sorry, that number is incorrect. The first loan amount on this should be $450,000, with the second being $50,000. So I got the numbers off just a little bit here, but it should come out to between $2,400 and $2,500, which is still a couple $100 less than the others. So the first at a 2.99% is a conventional loan, and on the second it's at 3.375% for a home equity line of credit, and that goes at interest only. And so that second is at a really low payment. Taxes and insurance are $575, and so the PITI right here it's $2,401. With the extra 50, it'll run at about $2,500. So that number was just off, didn't catch that. So the closing costs at about $5,000, or about 1% of purchase price. So again, with 80%, you're able to get 80% first, 10% second, and then 10% down for the 80, 10, 10. Okay, let's go ahead and move to the next on the 20%. All right, conventional 20% down, the upside. No mortgage insurance, no upfront fees at all. This is the most traditional down payment. When I was growing up and I bought my first house, this is what it was. You either came up with 20% down or you just didn't get into a house. They certainly have more programs now so more people can enjoy home ownership. But there's with no mortgage insurance and no upfront fees. With this other piece is a better chance for an offer to be accepted. Now, when somebody is selling a house, they want the strongest offer to make sure that it's not going to fall out of escrow. They want to make sure that whoever they pick, that they're going to be able to complete the transaction. And if somebody has 20% down, and in this case, it's $100,000 down, that means that person's pretty serious. Okay. And so in regards to that, we want to, in looking at that, we really think that the strength of your offer would be a really big deal in putting 20% down. The downside is not everybody can come up with $100,000 down. So let's go ahead and break down the numbers on this. I sure hope I got this right. Okay. So on a purchase price of $500,000, we got a loan amount of $400,000 at a rate of 2.99% with a 30-year fixed, principal and interest at $1,686, taxes and insurance $575, PITI is at $2,261. Closing costs are at $5,000 or about 1% of purchase price. As you can see, the payment's getting down there quite a bit. I'm going to go back, if you could go back to the Cal State FCU 80-10-10 on the numbers. Okay, I just wanted to take a look at this again. And you know what? I stand corrected. I wanted to correct this, is that those numbers are correct. I was just thinking, for some reason, I was thinking that first needed to be bigger than that. But just at a glance, in looking at it, it's absolutely correct. So on the Cal State LA FCU, our first loan being at $400,000, okay, and then our second loan being at $50,000, and then it's coming up with a $50,000 down payment plus the $5,000. So I just wanted to go back to that because I'm running through this pretty fast. So let's go ahead and move through to the first question. Oh, I'm sorry, back one to the comparison. All right, here we go. So low down payment comparison, here we go. We have the VA at 0% down at a $25.96. The FHA, as you can see, is quite a bit higher at $29.91. I mean, that's almost $400 higher for the FHA. But let me tell you this, though, the FHA is the most popular as far as the loans that are down, because with a VA, not everybody's a veteran, so not everybody can get that loan. The Home Ready, Home Possible is hard to qualify for in Southern California because of the you have to be 80% of the median household income here. And so the FHA is actually used more than anything else here. The conventional 5% down is $27.43. The Cal State LA FCU 10% down is only $2,401. I mean, you can see what a great program that is. Conventional 20% down is $2,261. So as you can take a look at these, and it's going to dictate how much money can you be able to save to qualify for these different programs. And granted, it's not the end of the world if you're paying the $29.91 for the FHA. If that's the way that you're able to get in on home ownership, you know what? You do what you need to do, and then you can refinance out of that FHA. Okay, you go ahead and get a little bit of equity in Southern California. It happens an awful lot here, so you're not stuck in any one of these loans forever. You can refinance out if you get more equity into the home. All right, let's go ahead and go to the first question. All right, question number 3. Do I have to have perfect credit to purchase a home? The answer is no. Let's go ahead and move to the answer here. So your middle credit score can be as low as 620. I mean, it could even be down to 500. It's just your programs are limited. Just remember, though, if the better credit score you have, the more programs, the better rate, the better pricing that you're going to have available to you. Credit score is important. It's not everything. Okay. I would say if you have lower than 620, I would probably give Cal State FCU a call, and we can run numbers for you, and we can tell you the difference in between 620 or whether it's 700. It's going to benefit you some, but it's not the end all. You can still get a loan at 620. You can get a better loan at 720. Okay. So let's go ahead and go to the next question. All right, so question 4, how do my student loans affect my ability to qualify to purchase for a purchase loan? Okay, answer. Next is, okay, so if your student loans are no longer deferred, your payment will be factored into your debt ratio. Remember that acronym that we had, the DTI, so debt to income ratio. So your student loan payment, if you're actually making payments, so it's not deferred anymore, and you're making those payments, whatever that payment is going to be factored into your debt to income ratio. And so that will affect it. But let's go ahead and take a look at if they're deferred. So if your student loans are currently deferred, in most cases, your payment will be considered as 1% of the balance of that deferment. Okay. Now that is in most cases. So in government loans, so the VA and FHA loans and all of Fannie Mae loans are all based on 1% of balance will be your monthly payment that will be factored into your debt to income ratio. Okay. Now, Freddie Mac is the other quasi agency. And if you're putting 20% down, we could either go with Fannie Mae or Freddie Mac. Okay. And so if you have the high down payment, yes, we can get lower than 1%, but for the most part, it's at 1%. So to answer the question as a whole is whatever your payment is would be counted against your debt to income ratio and could certainly affect how much of a loan you can qualify for. All right, so let's go to segment 3.